Tesla will report earnings after the market closes on Tuesday, and I don't think investors should expect very good results or very good guidance for the rest of the year. There's a few things that have happened just in the last couple of weeks that really tell that the picture is getting to be very tough for Tesla. One was the delivery numbers that they gave for the first quarter of 2024 that was down from a year ago. And it seems like momentum is just being lost all over the place. The next thing was the 10% layoffs that they had last week. It's never a good sign when a manufacturing company has to lay off workers. It tells you that they don't have enough demand for their vehicles. So they're having to cut costs by actually letting workers go, because you can't cut fixed costs. You can't eliminate a factory. You can't sell equipment. The easiest way to cut costs is just simply to eliminate labor costs. But the third thing, and I think the most striking, is continued cost cuts. Not only cost cuts for FSD, full self-driving supervised, which they're now calling it, but also cost cuts that we saw happen over the weekend, both in the US and China. There were reports of cost cuts of as much as 5% on certain vehicles. That's going to continue to pressure margins. Remember, every dollar of cost cuts that Tesla implements is a dollar of margin that they're not going to generate from the business. So there's a lot of things to look at when earnings come out on Tuesday, but the real focus is going to be on margins. Are Tesla's margins still higher than competitors? Are they now falling in line or even maybe below competitors? Is Tesla making money? And what does the rest of the year look like? Because it doesn't sound like there's any new vehicles coming. There's no refresh to the lineup. And so we may just be in a situation where conditions are going to continue getting worse throughout the year. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. You go to fool.com/ASYM. They'll give you their top 10 stocks to buy right now. Let's go through a few things that we know about the first quarter, and I'll start with deliveries and production. This is the first chart I want to go through, and this is deliveries in blue and production in red. There are a couple of striking things about this chart. The first is that deliveries are falling. So that likely means the revenue is going to be pretty sharply lower in the first quarter than it was a year ago, because not only did the Tesla deliver fewer vehicles, but those vehicles are being sold at lower prices. So don't be surprised if revenue is down really sharply. For context, total revenue in the first quarter of 2023, $23.3 billion. Analysts are estimating that revenue is going to be $22.3 billion. I wouldn't be surprised if we come in lower than that, but we'll see what the number looks like on Tuesday. The next and probably most important thing to look at is going to be margins. With any auto company, what you're going to want to watch is, are they able to price their vehicles to profitably sell them and match up supply and demand? So we've seen that demand is dropping and that supply exceeds demand, which means that Tesla is building inventory. They're having to discount vehicles. That's why you see in this chart right here, margins dropping sharply, 29.1% on the first quarter of 2022. Now gross margins are down to 17.6% or 8.2% from an operating margin perspective. That puts Tesla in line with other automakers. If margins start to fall even further, which I think they likely will in this quarter, given the delivery numbers, given those discounts, we're going to see profitability, free cash flow, everything about the income statement fall. And that's where the free cash flow chart really starts to get striking for Tesla. Despite the fact that the company has increased production over this period of time, since the beginning of 2021, you see that free cash flow increased throughout 2022. That was when they were increasing prices. There were still not enough vehicles to meet demand. But then as those price cuts started to hit, free cash flow started to drop as well. This is a trailing 12-month chart. So numbers are a little bit lumpy. The company did report $2 billion in free cash flow last quarter, but actually averaged less than $1 billion in the 3 previous quarters. So expect free cash flow to be down again in the first quarter after a weak first quarter of 2023. And one piece of this free cash flow that I want you to keep an eye on is inventory. You can see in this chart that Tesla built inventory really rapidly through the end of 2022. Now, inventory is measured in dollars, not in units. So that's why you see inventory drop in 2023. There was more vehicles in inventory, but not as many dollars in inventory because of the price reductions that were implemented last year. But look for this inventory number to go up in the first quarter because of the mismatch between deliveries and production. Tesla is making about 40,000 more vehicles in the quarter than they sold, which means that goes into inventory that comes out of cash And this is really where companies get into problems. This is why hardware and manufacturing is such a challenging business, because if you overbuild inventory, the only way to move product is to discount it. And that's exactly what we've seen Tesla do. So inventory is something that maybe doesn't get a lot of attention in the media, but it should be something that you watch when their financials come out. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now here's the last chart I want to show, because I think this shows the trajectory of expectations from investors. Now remember, Tesla's stock is down pretty sharply from its peak, but a lot of investors were still expecting growth from a revenue perspective and earnings growth long term. But the reality has been very different. Look at in late 2022, that was when margins peaked for Tesla. Remember, prices were very high, growth was really high. But since then, estimates have come down dramatically. First quarter 2024 estimates in late 22 were almost $1.50 per share. Right now, the average is about 50 cents per share. That's what analysts are expecting. So the stock has come down sharply, but hasn't even come down as far as estimates have. If you go to the annual number, the trend gets even worse. You can see that 2024 fiscal year estimates as early as the beginning of last year were for $6.62. Now investors are only expecting $2.74 per share in earnings this year. I think even that might be high. I'm going to go out on the limb here and say that I don't know that Tesla is going to be profitable this year if these trends continue. The bottom line is that Tesla is making more vehicles than they can sell. They're having to discount those vehicles. There's more competition coming into the electric vehicle market. And at the same time, interest rates continue to rise, which is going to make it more difficult to sell vehicles. This is the challenge when you have a company like Tesla, which is trading for a massive premium to a lot of its competitors. Tesla's forward price to earnings multiple, remember that multiple those earnings estimates that have been coming down? The forward multiple is still 50 times. Most automakers today trade for about 5 times earnings. So Tesla is 10 times more expensive on that metric. On a price to sales multiple metric, most automakers sell for about 0.3 times sales. Tesla sells for nearly 5 times sales. So Tesla is 16, 17 times more expensive than its competitors on a price to sales multiple. By any way you slice it, Tesla is more expensive than competitors. And the reason is that investors were expecting this to be a different company. They weren't expecting this to be just the same old automaker making a okay margin, having volatile results, and being at the whims of supply and demand. But that's exactly what we have seen Tesla be over the last 18 months. And I think we're going to see that continue in the first quarter. I think we're going to see really weak results. I think we're going to see poor guidance for the rest of the year because there's nothing really drumming up more sales for Teslas. Even FSD, which I expect to be something that they talk a lot about on the conference call because the auto manufacturing business is not doing particularly well. So they have to change the focus to FSD. But even that is not getting high adoption and it's not approved for actual full autonomous driving. Yes, it's getting better, but they're nowhere near. They're multiple years away from this getting regulatory approval for any sort of level 4 or level 5 autonomous driving features. So I think there's a lot to prove in Tesla's results, and I think investors really need to temper those expectations. I have been covering since December 2022, when Tesla started discounting their vehicles, that there were problems emerging for Tesla, and that has been right ever since. I get a lot of pushback on every single one of these videos because I'm looking at the numbers, I'm looking at the metrics, I'm looking at the trends for Tesla's business, and they are not good. Investors need to realize that that is the case, and we will see exactly what results look like after the market closes on Tuesday. What are you expecting from Tesla's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.